Let's say I lost everything tomorrow. No portfolio, no savings, just zero. If I had to start over in 2026 with what I've learned, I wouldn't chase hot stocks or try to be clever. I'd keep things simple and invest in ETFs. Most investors don't struggle because they choose the wrong investments. They struggle because they overcomplicate decisions that don't need to be complex. The real challenge isn't finding more options. It's knowing what actually matters long term. In this video, I'll walk you through a simple 3 ETF portfolio and explain why these specific ETFs cover what actually matters long term. I'll break down what each one does and how they work together. I'll also show you how this same portfolio can be structured for income or for growth using the same 3 ETFs without needing a whole new strategy. And at the end, I'll show you how one version builds a portfolio close to $1 million that pays over $2,000 a month in dividends, and another that grows to $2 million by focusing purely on growth. Before we talk about specific ETFs, we need a few rules that don't change no matter who you are, how much money you make, or what the market's doing. These rules apply if you're just starting, if you're resetting, or if you've been investing for years but feel like your portfolio doesn't quite match your life anymore. The first rule is that time decides emphasis. Not investment opinions, not headlines, not what did well last year. Time. When you have time ahead of you, the portfolio leans toward growth because your contributions are small relative to the time they have to compound. The second rule is that capital has to exist before income matters. This is where a lot of people get tripped up. Income feels productive because it's visible. You see cash hitting your account and it feels like progress, but mathematically, income drawn too early slows compounding. A portfolio that pays you before it's large enough is doing the job of a later stage portfolio too soon. You're asking it to support you before it's finished building you. The third rule is that volatility isn't the enemy people think it is, especially when you're contributing regularly. Volatility only becomes dangerous when it changes behavior. If you're adding money consistently, price swings actually work in your favor over time. You're buying more shares when prices are lower and fewer when prices are higher. The real risk isn't fluctuation, it's panic. It's stopping contributions. It's locking in losses because the portfolio didn't match your expectations emotionally. Now, this is where ETFs come into play, and I want to keep this simple. An ETF is just a structure. It's a way to own a large group of companies all at once, automatically, at a very low cost. You're not picking winners, you're buying systems that evolve on their own. Companies that stop performing fall out. Companies that grow become a bigger part of the portfolio. That automatic adjustment is a massive advantage over trying to manage everything yourself. When you apply these rules using ETFs, investing becomes about staying invested long enough for compounding to do its job. The goal isn't to be right this year. The goal is to still be invested 10, 20, 30 years from now with a portfolio that changes its emphasis as your life changes. With that framework in place, the question isn't how many ETFs you need, it's which few can handle different jobs over time without forcing you to rebuild the portfolio as your priorities change. VOO fills that role. It's the core holding that stays in place regardless of whether the portfolio is emphasizing growth or income. VOO tracks the S&P 500, which simply means it owns the 500 largest publicly traded companies in the United States weighted by size. When companies grow, they become a bigger part of the index and ultimately your portfolio. When they shrink or fall behind, they eventually get replaced. You don't have to predict which companies will win. The index does that work for you over time. When people hear that, it sounds boring, but boring is exactly why it works. The S&P 500 has survived wars, recessions, inflation spikes, interest rate cycles, tech bubbles, and financial crises. Entire industries have come and gone, and yet the index keeps moving forward because it constantly renews itself. The companies that drive productivity, innovation, and profits today are not the same ones from decades ago, and VOO automatically reflects that change. The math behind this is simple but powerful. Historically, VOO has delivered long-term share price appreciation of about 12.47% per year, while also paying a dividend that currently yields around 1.12%, growing at roughly 6.17% annually. Those numbers aren't guaranteed year to year, but over decades, it's been remarkably consistent. At the same time, VOO charges an expense ratio of about 0.03%. That means for every $10,000 invested, you're paying about $3 per year in fees. Compare that to actively managed funds that charge 1% or more, and the difference compounds into hundreds of thousands of dollars over a lifetime. This is why matching the market already puts you ahead of most investors. After fees, taxes, and bad timing, the majority of people who try to beat the markets end up falling behind it. VOO doesn't rely on being smarter, it relies on participation. As long as the US economy grows over time, this ETF captures that growth with very little friction. And this is why VOO works as the base for both types of investors. For growth-focused investors, it provides broad market exposure and long-term appreciation that compounds with time. For income-focused investors, it represents ownership in profitable businesses that generate real earnings and cash flow. The emphasis may change, but the foundation does not. VOO doesn't try to be exciting. It provides a stable base that allows the rest of the portfolio to do its job without carrying everything on its own. Once the foundation is in place, this is where the direction starts to depend on what you want the portfolio to emphasize, income or growth. Not because the rules change, but because what the portfolio is being asked to do changes. When growth is the priority, it naturally gets more weight. And that's where QQQ comes in. After QQQ, I'll show you one more ETF that completes this portfolio. Then I'll walk you through how these three ETFs can be combined to focus on income or on growth. And at the end, you'll see how one version builds a portfolio close to $1 million that pays over $2,000 a month in dividends, while the other grows to $2 million by focusing purely on growth. QQQ tracks the NASDAQ 100, which means it owns 100 of the largest non-financial companies listed on the NASDAQ exchange. In practical terms, this tilts the portfolio toward companies that are heavily focused on technology, innovation, and scale. These are businesses that tend to reinvest a large portion of their cash back into growth, whether that's software, data centers, automation, or entirely new products and services. The reason this matters comes down to one concept: return on capital. A company that can consistently reinvest its profits at high rates compounds faster than one that can't. Over long periods of time, that difference is massive. Even a few percentage points of higher annual returns, sustained for years, can mean the difference between an average outcome and a life-changing one. That's why growth-heavy ETFs like QQQ have historically outperformed broader market indexes over long stretches. In fact, over the last 10 years, QQQ has averaged an annual share price appreciation of about 18.45%. Of course, that higher return potential comes with higher volatility. QQQ will fall harder during market downturns, it always has, but volatility by itself isn't the risk most people think it is. Risk is being forced to sell at the wrong time. And when you're early in your investing life and contributing regularly, you're not forced to sell, you're buying. Lower prices simply mean your contributions buy more shares. This is where the math starts to work in your favor. If you're adding money consistently, downturns don't damage long-term outcomes, they improve them. You're dollar-cost averaging into volatility. Over time, the market recovers, earnings grow, and those extra shares compound. The only way volatility becomes harmful is if it pushes you to stop contributing or abandon the plan altogether. Historically, QQQ has experienced drawdowns of 30%, 40%, and even more during major market events, and yet, over long time horizons, it still delivered higher annualized returns than the broader market. That doesn't mean it will outperform every year, it means that patience is rewarded when growth is the priority and time is allowed to absorb short-term pain. This is why growth-heavy exposure makes sense when the goal of the portfolio is maximum compounding rather than immediate income. The dividend stream is intentionally small because most of the return is coming from reinvested earnings inside the companies themselves. Volatility is the price paid for higher expected growth, and when growth is the objective, that price is rational. But this is also why growth should never be the entire plan forever. As portfolios grow and priorities shift, the emotional cost of large drawdowns increases. What feels tolerable at $50,000 feels very different at $1 million. Growth does the heavy lifting when appreciation is the focus, but it's not meant to carry the portfolio alone indefinitely. QQQ's role is not to replace the foundation, it's to accelerate it when growth is emphasized over income. It adds horsepower to the system during periods when compounding speed matters more than stability. And once that acceleration has done its job, the portfolio benefits from rebalancing emphasis towards income and stability using the same system rather than abandoning it. This is where a lot of investing conversations go wrong because income gets framed as either good or bad, smart or outdated. In reality, income is neither. It's simply a different priority. And this is where SCHD fits into the system. SCHD focuses on high-quality companies with strong cash flow and a history of paying and growing dividends. These are businesses that are already profitable, already established, and already generating more cash than they need to reinvest aggressively. Businesses like Coca-Cola, PepsiCo, Texas Instruments, Cisco, and Verizon. They're focused on consistency, durability, and returning capital to shareholders rather than chasing aggressive expansion. The mistake many people make is treating dividends as the goal from day one. The math doesn't support that. When a portfolio is small, the cash flow isn't meaningful enough to change outcomes, but the cost to compounding is real. Every dollar paid out is a dollar that can't compound internally at higher rates. That's why income-heavy portfolios tend to lag during the early years. But that doesn't mean dividends are useless, it means they solve a different problem. When a portfolio is small and you're still adding money, income doesn't change outcomes much. But as the portfolio grows and contributions become a smaller part of the equation, cash flow starts to matter. At that point, dividends reduce the need to sell shares to generate money. During market downturns, that matters a lot. Instead of being forced to sell assets at lower prices, the portfolio continues producing cash. That makes drawdowns easier to live with, keeps volatility lower, and reduces the chances of making emotional decisions at the worst possible time. That behavioral stability has real mathematical value. Staying invested through bad markets does more for long-term results than squeezing out a little extra return in good years. SCHD plays this role well because it's selective. It doesn't chase the highest yield. It focuses on balance sheets, payout ratios, and sustainability. SCHD carries a current dividend yield of about 3.77%, with dividend growth averaging 10.61%, while share price appreciation has averaged around 7.82%. That combination favors reliability over speed, which is exactly the point when income is the focus. Reinvested dividends buy more shares, which generate more dividends, which then buy more shares. Over long periods, that feedback loop adds up. More importantly, during market downturns, dividend-focused portfolios tend to fall less, which reduces the odds of panic selling when portfolios are large and emotions run even higher. This is why SCHD fits naturally when income and stability are emphasized. It's not there to maximize returns, it's there to support behavior, consistency, and sustainability without dismantling the growth engine that built the portfolio. And when you strip away the narratives and just look at the numbers, this is how the three ETFs compare. Each one excels at a different job, which is exactly why they work together instead of competing with each other. At this point, all the pieces are on the table. We've covered the rules, the foundation, the growth engine, and the stabilizer. This is where most investors get tripped up because they assume growth and income require entirely different portfolios, different strategies, different accounts, constant reinvention. They don't. What actually changes over time isn't the system, it's the priority. The same three ETFs can be arranged to do very different jobs depending on what you're asking the portfolio to accomplish. One version emphasizes growth, the other emphasizes income. They're not competing ideas, they're two expressions of the same system. To make this concrete, let's lock the variables so the comparison stays clean. Assume you're starting from zero. You invest $10 a day, every day. Dividends are fully reinvested. There's no market timing, no stock picking, and no tactical moves. Just consistent contributions and the same 3 ETFs working in different proportions. When growth is the priority, you allocate a larger share of the portfolio to growth-oriented ETFs. More weight goes towards assets designed to reinvest earnings and compound faster over time. This increases volatility, but with a long-term horizon and consistent contributions, that volatility works in your favor by accelerating portfolio growth. When income is the priority, you shift more of the allocation toward income-focused ETFs. Growth exposure is still there, but a larger portion of the portfolio is directed toward assets that generate steady cash flow and reduce drawdowns. Nothing else changes. You're not starting over, you're not abandoning growth or suddenly becoming conservative. You're simply adjusting the weights so each ETF does the job it's best at for that specific goal. That's why thinking in terms of portfolio expressions is so powerful. You're not changing strategies over time, you're using the same system to serve different types of investors. It's one portfolio structure built from the same 3 ETFs. The difference is simply what the investor wants the portfolio to do. A growth-focused investor uses this system to prioritize compounding and long-term appreciation. An income-focused investor uses the same system to prioritize cash flow and stability. The ETFs don't change. The rules don't change. So the real question isn't, am I a growth investor now and an income investor later? It's, what outcome do I want this portfolio to optimize for? Now, let's look at the income-focused version of this same system and actually put numbers behind it. This portfolio is built for someone who wants their investments to produce steady cash flow and feel more stable, even if that means giving up some upside. Nothing complicated is happening here. It's the same 3 ETFs, the same $10 daily contribution, just weighted to favor income. In this setup, 20% goes into VOO, 10% into QQQ, and 70% goes into SCHD. That heavier tilt toward SCHD pushes the portfolio toward companies that consistently generate cash and return it to shareholders. Because of that, the portfolio starts with a current dividend yield of about 2.91%. Those dividends grow at an average rate of 9.61% per year, and even with income as the focus, the portfolio still averages about 9.81% in share price appreciation. Growth is still there, it's just not doing most of the work. To keep the comparison fair, the assumptions stay the same. You start from zero and invest $10 per day. That works out to $3,650 per year with dividends fully reinvested and no changes along the way. From there, the numbers build gradually. After the first year, the portfolio sits at $3,650. After 10 years, it reaches about $66,195. After 20 years, it grows to roughly $283,496. And after 30 years, it ends up around $992,646, just under $1 million. By year 30, this portfolio is projected to generate about $24,123 per year in dividends, which comes out to roughly $2,010 per month. That income arrives without needing to sell shares, and that alone changes how the portfolio feels during market downturns. Looking at where that value comes from helps explain why. About $883,146 of the final portfolio value is value added beyond your contributions. Roughly $688,105 comes from price growth, and about $195,041 comes from dividends being reinvested over time. Those reinvested dividends help smooth out the ride. This version of the portfolio is about reliability. It's built to generate cash, reduce emotional pressure, and stay usable even when markets are unpredictable. But that stability comes with a trade-off. When income takes the lead, total growth slows down. And to see just how big that difference can become, we need to look at the growth-focused version of the same system, built with the same $10 per day and the same 3 ETFs, but weighted for a completely different outcome. A growth portfolio is built for someone who doesn't care about income right now and is focused almost entirely on how big the portfolio can become over time. Here, 20% goes into VOO, 70% goes into QQQ, and 10% goes into SCHD. That heavier tilt toward QQQ pushes more of the portfolio into companies that reinvest aggressively and compound faster. The trade-off is volatility, but the payoff is scale. With this allocation, the portfolio starts with a much lower current dividend yield, about 0.92%. Dividend growth averages around 8.91%, and average share price appreciation jumps to roughly 16.19%. The assumptions stay exactly the same. You start from zero and invest $10 per day, which is $3,650 per year. Dividends are reinvested. Here's what the projections show. After the first year, the portfolio is worth $3,650. After 10 years, it grows to about $80,884. After 20 years, it reaches roughly $452,350, and after 30 years, it ends up at about $2,133,710. More than $2 million built using the same daily investment. Income stays intentionally small. By year 30, this portfolio generates about $1,888 per year in dividends, or roughly $157 per month. That income is almost irrelevant compared to the size of the portfolio, and that's by design. Nearly all of the value comes from capital appreciation. When you break it down, about $2,024,210 of the final value is value added beyond your contributions. Roughly $2,003,351 comes from price growth, while only about $20,859 comes from dividend reinvestment. Want to know how a simple $5 a day investment can grow into a portfolio that pays more than $8,000 a month in dividend income? Click the video on the screen to find out.